For 15 years, a Texas schoolteacher named Kayla Morris saved everything she could to build a home for her family. When she and her husband sold that house, they took the proceeds, $282,153, and moved it somewhere they were told was completely safe. Not a stock. Not crypto. A savings app that advertised, in plain language, that the money was FDIC-insured, as protected as any bank in America. Months later, she sat in a courtroom and learned what she'd actually get back: $500 out of $282,000. And Kayla Morris wasn't alone. More than 100,000 Americans woke up one day locked out of their savings. Money they'd been promised was untouchable. One person put in $15,000 and got back 75 cents. So how does that happen? How does FDIC-insured money just vanish? The answer is a kind of company most people have never heard of, and a gap in the system big enough to swallow a life's savings. Here's what makes this story so unsettling. Nobody here was gambling. These weren't risky bets. These were regular people, teachers, FedEx drivers, parents saving for tuition, who did the responsible thing and put their money somewhere that said FDIC-insured right on the screen. The trap wasn't that they took a risk. It's that they took what looked like the safest option on earth, and it had a hole in it they couldn't see. Let me show you the hole. The apps that felt like banks. It starts with a wave of slick, friendly apps. The main character is one called Yotta. And Yotta had a genuinely clever hook. It turned saving money into a lottery. Instead of paying you a boring little interest rate, it entered you into Powerball-style prize drawings. Save more, win more, up to $10 million. One of its early headlines literally read, "Win millions by saving in an FDIC-insured account." Yotta wasn't the only one. There was Juno, Dave, Copper, an app aimed at teenagers. All sleek, all modern, all offering high interest and a better experience than your stuffy old bank. And critically, they all prominently advertised FDIC insurance. Some customers even emailed to double-check, "Is my money really safe?" And they were told, in writing, yes, it's FDIC insured. So people believed it. Why wouldn't they? Since 1934, the FDIC has never let a single depositor lose a penny of insured money. Those 4 letters are the most trusted promise in American finance. But here's the part almost nobody understood. Yotta was not a bank. The hidden structure, the reveal. This is the piece that was invisible to customers. And once you see it, the whole thing makes a sick kind of sense. When you put money into an app like Yotta, it didn't go straight into a bank. It traveled through 3 sets of hands. First, the app, Yotta, which you could see. Then, a hidden middleman in the middle you could not see. And finally, a small partner bank at the end, like Evolve, where the money was actually held. That middleman is the key. It was a banking-as-a-service company called Synapse. Synapse's job was to be the plumbing, to connect trendy apps to real banks so the apps didn't have to become banks themselves. And instead of giving each customer their own bank account, Synapse pooled everyone's money together into giant shared accounts, labeled for benefit of the customers. Which means the bank at the end didn't know who you were. It just saw one enormous pile of money belonging to Synapse. The only place that tracked who actually owned what, your slice of that giant pile, was Synapse's own ledger. One company, one set of records, holding the only map of whose money was whose. Now watch what happens when that company falls apart. The trap springs. In April 2024, Synapse filed for bankruptcy. Weeks later, the accounts froze. More than 100,000 people, cut off from a combined $265 million overnight. And here's the trap, the thing nobody saw coming. FDIC insurance is real, but it only does one thing. It pays you back when a chartered bank fails. That's it. That's the whole promise. Synapse wasn't a bank. It was middleware, plumbing between apps and banks. So when Synapse collapsed, no bank had failed. And if no bank fails, the FDIC doesn't pay. The insurance everyone was promised simply did not apply to the thing that actually broke. But it got worse. Remember, Synapse was the only one keeping the ledger of who owned what. So when Synapse imploded, it didn't just freeze the money, it destroyed the map. Investigators tried to reconcile the accounts and found the numbers didn't add up. A shortfall somewhere between $65 and $95 million. Money that was simply not there. And nobody could fully explain where it went. Think about that. The safety net didn't catch these people, and the record of what they were even owed had been shredded. The outrage. Who knew? So the natural question is, was this a freak accident? Or did someone see it coming? They saw it coming. Reporting later surfaced an email from 2022, 2 years before the collapse, in which one of the partner banks warned Synapse that their records of how much money existed differed by, in their words, a couple $100 million on the daily. Hundreds of millions of dollars of disagreement, routinely, years before anything froze. Regulators eventually called the FDIC-insured marketing what it was: deceptive. California fined Yotta $1 million, with a state official saying the company had blatantly deceived thousands of its customers. And now everyone's pointing fingers. Yotta says it's not a bank and never held the funds, and blames the partner bank. Others blame Synapse's leadership for what they call gross mismanagement. That fight is still grinding through the courts, but while the companies argue over whose fault it is, the people who actually lost the money are still waiting. Late in 2025, a federal agency set aside about $46 million to help compensate victims. But that's only about half the shortfall. And the payouts have been painfully slow. The broader warning: this could be you. Now here's the part I really need you to hear, because it's bigger than one app. You might be thinking, I'd never use some lottery savings app. Fair. But here's the uncomfortable truth. A lot of the most popular money apps in America aren't chartered banks either. Cash App, PayPal, Chime, Venmo. These are technology companies. They partner with banks to hold your money, often in the same kind of pooled structures. Chime even says it directly in its own filings. It's a technology company, not a bank. Now, that is not a prediction that any of them will fail. Most are far larger and more established than Synapse ever was, and millions of people use them every day without a problem. This is not a reason to panic. It's a reason to understand one thing. FDIC-insured on an app does not mean what most people assume. It doesn't insure the app. It insures a bank if there's a real direct account at a real bank, and if the records survive to prove the money is yours. So the single most useful question you can ask about any app holding your money is a boring one. Who actually holds it? Which bank? Is the account really in my name? Because the answer is the difference between a safety net and a marketing slogan. For almost 100 years, FDIC-insured has been the most reassuring phrase in American money. It's shorthand for untouchable, guaranteed, safe. And that reputation was earned. The FDIC really has protected depositors, without fail, since 1934. But this story exposed the fine print underneath the feeling. Those 4 letters protect a bank account. They don't protect an app that looks like a bank, sounds like a bank, and quietly isn't one, with an invisible middleman standing between you and the vault. Kayla Morris didn't take a risk. She thought she'd removed all the risk. That's what makes it devastating. The word bank and the letters FDIC felt like a guarantee. Tens of thousands of Americans just learned, the hardest possible way, what happens when they're only marketing. So before you trust the next app that promises your money is safe, don't just look for the logo. Ask where your money actually sleeps at night. Because insured is only a promise if there's something real underneath it.